Hello, everybody. This is Dawn from Hitroff Consulting and Business Services. Today, we are going to do our coffee break series on assets and liabilities. This is important for every small business to understand. Even if you feel that right now you're just a hobbyist or just starting, sole proprietor, gig worker, it's important to know assets and liabilities because as your company grows, you're going to want to make sure that these are categorized correctly for your business. Um, Assets are property owned by the company. Um, they're re- they have value and can be liquidated when needed. So they build value to your business. Liabilities are debts that are owed. And obviously, because they're a debt, they subtract the value from your business. So it's important to know how to categorize these correctly in order to validate your business correctly when you're especially if you go in for a business loan. This is really important, or even just a grant. The importance of assets to a company. um, Again, assets add value, increasing the net worth of your small business. An example would be you start your company with $5,000. This would be considered the basis of the company. Then you purchase, roughly $25,000 of equipment in order to run your business appropriately. This now makes the net worth of your company $30,000 and not 5,000. Um, there are different areas of assets. There's tangible assets, which are vehicles, inventory, furniture, and cash. Intangible assets would be things like trademarks, patents, drafts, and plans. Current assets, these are things that typically can be liquidated quickly. Accounts receivables is a current asset, along with prepaid expenses. Why prepaid expenses? A prepaid expense is basically like a deposit. That's something that you can get back if you did not move forward with that particular expense. Um, Non-current assets, um, office supplies, furniture, shop equipment, and property. Operating assets would be equipment necessary to perform business. Like you cannot, if you do SEO marketing, you cannot perform business unless you have a computer. If you're a contractor, you cannot perform business unless you have a truck to get to and from your jobs and or the equipment necessary to perform the tasks while you're on the jobs. Those are operating assets. Non-operating assets would be like land that maybe you might store your equipment on, or loans, receivables. For instance, I have some clients that do hard loans to companies that are either startups and can't get loans elsewhere. Those loans receivables um, are non-operating assets because they could cash out on that money, like ask for all the money back all at once if they themselves were in hardship, or just the individual themselves that borrowed the money was able to pay them off. Those are non-operating assets because it's an asset to the individual who loaned the money, um, so they're able to get that money back. It's a liability to the person who borrowed it. So next, how liabilities affect your company. Um, Everybody understands paying their bills. You do that on a daily basis. Basically, that's a liability. Your PG&E bill, your rent, those are all liabilities, whether it's personal or business. Um, how liabilities affect the company, it decreases the value of your company. Using the previous example um, of starting your company with $5,000 and then purchasing equipment of $25,000, if you have liabilities that you owe in the amount of, say, $10,000, your company net worth is now $20,000 and not $30,000, because you have to subtract the money the company owes from the company's net worth in order to give it a value. Um, there's two different types of liabilities. There's fixed and there's variable. And when you're doing a budget, um, you want to make sure you separate them that way. Fixed liabilities are bills that are owed by the company that are the same exact dollar amount and are payable the same time frame every single month. Like your rent is always due by the 5th. That's a fixed liability. Loan repayments, those are fixed liabilities. Subscriptions, again, those are fixed liabilities. Examples of variable liabilities would be your utilities, PG&E, water, garbage. Yes, you do pay them every month, but they vary. One month your electric bill is going to be 52 bucks. The next month your electric bill might be $200. So they're a variable liability, along with vendor invoices. They're not always going to be the same amount every month. Employee wages, that's another variable liability. And taxes. That's would go under your variable liabilities when you're doing your budget. Um, can an asset be a liability? Yes, it can. An example would be if you purchased a truck. You're a contractor, you need a new truck in order to go out and do your bids or to haul equipment to and from a job site. So you purchase a 2023 truck. Um, the total purchase price is $87,000. You're going to put that truck in your system or on a piece of paper, and it is an asset to the company for $87,000. However, you had to finance a portion of this new truck. So, say you put $20,000 down as a down payment, and then you're going to finance $67,000. That $67,000 is now a liability to the company. Okay, so your asset is 87,000, but your liability is only 67,000, and that's because you invested 20,000 from the company into that asset. Okay, so you need to make sure you record that correctly, and when you put your liability account in the system, you do not put that $20,000 in your liability account, because that 20,000 is not a liability. The 20,000 was an expense for the asset, and then your liability is only the $67,000. What about things that you keep on hand or in stock? Yes. Inventory. This is a hard one for a lot of people because they feel it takes too much time invested to keep track of inventory. They would just rather write it off as an expense. Um, however, it benefits you if you're going to be purchasing an overstock of items, regardless if they're in stock for sale and or for use. um, Inventory is an asset to the company, not an expense. Why? Well, because if you needed money, you can sell that overstock that you have to put money back into the company. An expense is something that you purchase and use immediately, um, regardless if it's a supply or it goes directly to a specific job. Um, an example of inventory, you purchased, we'll use contractors again because that's easy. You purchased 42 2 by 4s. Okay, but you only use 18 of them for a job, and at the end of the year you have 24 2 by 4s sitting in your shop. Okay, those 24 2 by 4s, that's an asset. That's money for the company. It can be liquidated into money, so that's an asset. um, why is that important? Well, assets affect your taxable income. Um, so that inventory, what it does is it reduces the amount of revenue um, that is subject to tax. And by subtracting or deducting um, the cost of goods sold from revenue, um, it can lower your taxable income, and your, obviously, along with that, lowers your taxable liability. Um, and how it does that, it's because you spent the money for those two by fours. However, you have not made money off of those two by fours yet. Um, that's how it lowers your tax liability. So again, I know today seemed to be a quick, short video, but the purpose of these are to just give you the basics of specific areas of your business. If you would like to get a little more in depth on assets and liabilities for your company, please like this video, subscribe to our channel. And what I'm going to be doing is I'm doing two breakout videos, one specifically on assets and then one specifically on liabilities for your company to help you keep track. Thank you again for watching, and we will see you later.